While we picked most of the sectors that underperformed, financials, healthcare, and real estate, we also have to look at where we didn't trade very effectively. We were terribly wrong about consumer discretionary. We thought that the consumer would be strapped, that we thought unemployment would get worse. It has. We thought retailers would underperform because of it. They did not. This was one of the strongest performing sectors this year. Not the strongest, but one of. And as of today, it's one of the most heavily shorted sectors in the market. So clearly we're not alone. But the point is, you can't just sit there and lose money. So how did we trade it? Well, admittedly, we traded it bearish. In the retail space, you'll always trade, most people anyways, will trade a lot more consumer discretionary stocks than precious metals in most cases. Think of all the retail discretionary companies, Nike, Target, Best Buy. I mean, the list goes on and on. Toyota Motor, Ford. These are all in the retail discretionary space. 28 total trades, 7 bullish, 3 neutral, and 18 bearish. We had 15 profitable, 13 losing trades. Average return almost negative 1%. So our worst sector, we didn't just stand in front of it and get run over, but admittedly we should have looked elsewhere. And what can you say? We should have looked elsewhere apparently. Comments below were made last year. These were the things we thought you should consider. Deflationary environment, similar to Japan. Well, how did the Fed fight that off? Remember, in August, remember where we were. We were at 1040 in the S&P at the end of August. Remember that deflation was staring us right in the face. And the markets, we would have been spot on, but they didn't allow that to happen. They stepped in and they initiated quantitative easing part 2. Will we stabilize as an economy and work our way out of this mess without major repercussions? Will we have massive inflation from all the money that's been pumped into the economy? This is why we've been so bullish. Our bullish view on precious metals has been actually multi-year, but last year, that was a big part of it. Next year, the market gets a little bit of a reprieve, we think, from the rising gold and silver type of prices and more of an economic bump up. So things start to come together. Unemployment starts to come down a bit, and you get a little bit of an improvement in some of the underlying fundamentals. Expectations for last year. We talked about this at nausea, and many of our members heard about this all year long. So we continued to emphasize, and we talked about this back in last year's class, in fact, correlation between price action. Here was the bear market, a couple of years in the making. Look at the highs and look at the lows. Here was the 2007 to 2009 bear market. Look at the highs, a little bit higher. Look at the lows, a little bit lower. But for all intents and purposes, same time frame, same type of price levels. Here was 2003, the year we came out of a recession, the first year of the bull market, and the largest price increase. Here was 2009, the year we came out of the bear market, came out of the recession, largest price increase, day one or year one of the bull market. What did we say 2010 would be like? Well, should be like 2004. A lot of back and forth, a lot of sideways movement, and at the end of the year, the market spiked higher. The difference was, we said, well, we chop around, we can't make the assessment that it's going to spike higher at the end of the year. We should have, because it looks perfect. We chopped around all year. In the summer, we bottomed, and by the end of the year, we were at new highs. That is exactly how 2010 has played out. Basically, at much the way we anticipated, with a surge at the end of the year. Our view was, well, we've got deflation, we've got other factors. The market's going down towards that lower level at some point. It did, it just turned up by year's end. So 2010, we're up roughly 13%. 2009 was the year we came out of that bear market. 2008 obviously was right in the bear market and just a terrible type of price action level. Here's another thing we talked about a lot, Fibonacci levels. This is taught in class 306 in advanced technicals. The S&P hit a high of 1576 in 2007, hit a low of 666 in 2009. The total drop was 910 points. That's from our peak, the top, to the bottom. So a key level in Fibonacci's is 61.8% retracement. That puts us at 1,228. This was a critical level. Well, two separate times in 2010, we retraced back to that big retracement of the bear market slide. We said that's going to be important. In fact, the first time we hit there was in April, and you can see how that turned out. The second time was actually just a couple of months ago, and you can see us correct back off of that. We anticipated that we would ultimately break through, which we now have. You can see the cup and handle formation there. That becomes a critical area going forward. So 1,230 should be on your radar screen, whatever you use as kind of a market gauge. Any pullbacks to that now become support. We have now moved above 61.8% of the bear market retracement. That's an important level. You can see how these levels, here's 38 where it became support on multiple occasions. You can see us bumping into 50% retracements, and once we cleared 61.8, we've continued to accelerate further and further. So this is a weekly chart of 2010. We got the dip we expected. We ultimately hit the low we expected, and now you can see where we came up with that price target. Why did we say 1,020? Well, we anticipated that the markets would at some point in the year probably go up towards 1,230, but end up closer to 1,020 by year's end. Well, it didn't happen. That, everything was sped up as we talked about. It got there and then reversed right back out of that to new highs. So here's our forecast going forward. Banks are now loosening standards, issuing debt. Through the end of October, companies had tapped the debt markets for over $570 billion in new bonds, on pace to challenge the $800 billion in 2009 that they borrowed, already coming in higher than 2000 through 2008. Now, why is this important? Much of this debt has been at very low cost. Rates are at extreme lows. Microsoft issued a 3-year bond with interest at 0.875. Walmart and Coke borrowed at 0.75%. As a result, corporations are sitting on a real big pile of cash, 1.9 trillion, the largest as a percentage of total assets since 1959. This money is finding its way into stocks through stock buybacks. They're paying more dividends. They'll continue to raise those dividends in our estimation. Stocks are offering a higher earnings yield than bonds. That's important. Here's where money flows into stocks, and here's where this is part of what continues to fuel the market. So why would we dump bonds for stocks? Let's look at an example. Johnson & Johnson sold a 10-year bond at 2.95%. The stock has a dividend yield of 3.46%. So would you want to buy a 10-year bond that's paying you 2.95%, or the stock that's paying you more than that to own it? Keep in mind, Johnson & Johnson has boosted its dividend for 48 straight years. Would you rather lock in at 2.95 or be paid 3.46 over the next 10 years? If they've raised the dividend for 48 years in a row, do you think they're going to raise it in the next 10 years? Yeah, probably every year. Do you like being paid the higher yield, have all of the upside for the next 10 years in the stock, and the increase in dividends? In other words, would you want to own Johnson & Johnson's bonds or its stock? We think the argument is pretty obvious. Okay. Microsoft, same thing. 10-year bond at 3.1%. Their dividend is not quite that at 2.4, but Microsoft is somewhat more of a growth stock, still paying a dividend that's close to it. They're raising their dividend. They're sitting on a pile of cash. We, in full disclosure, currently own Microsoft, at a cost basis of $25.33 after you factor in dividends and covered call income. These will be on our radar screen. These are the type of companies that you can continue to feel safe with because you can see the difference there. Now, it doesn't guarantee success, but that's how you take advantage of the markets. So here's J&J, and frankly, the reason we're not in it, well, the pattern's not very conducive for buying unless we stabilize here. We're still above the 200, but you can see kind of a wedge pattern forming here, and the stock could, in theory, break either way. If it breaks lower, we'll let it fall, and we'll try and pick it up at a better price later on if we play J&J. Not the fastest of movers and kind of a patience trade. Typically, Microsoft is as well. However, we've timed this one pretty darn well. We bought back here originally through an earnings play and then sold the position. We bought back in here, actually got in a little bit early. It dipped a little further, never stopped us out, and has returned back up to these levels. So I think we made 4% here, and we're up, close to 10% here, all in the last couple of months. Remember, it's paying a dividend that is larger, well, not Microsoft, just slightly less than its 10-year yield on its bonds. Another way to look at markets and figure out where your value is, you can look at basically a PE ratio in reverse, what they call earnings yield. You basically take the earnings per share for the most recent 12 months, what they call the TTM, trailing 12 months, divide that by the current market price per share, just the inverse of the PE ratio. You can then compare that to Treasury yields over a 10-year period of time and kind of see where value is. This shows the percentage of each dollar invested in the stock that was earned by the company, used by many investment managers to determine best asset allocation. So stocks are cheap versus bonds to a level that we haven't seen in quite some time. Bonds had their bull market, and in fact, here is just an extreme bull market in bonds. If you held bonds in 98 and 99, or pardon me, 2008 and so forth, as the markets were getting crushed, if you held treasuries, they're about the only asset that went up in 2008. Everything else, gold went down, stocks went down, corporate junk type of bonds and so forth went down, but treasuries went up. How cheap are stocks right now on a relative basis? You can see how rare this is from the charts. The chart illustrates the recent rise in the equity risk premium, basically a measure of how richly stock investors are being compensated relative to bond investors. For most of the past 30 years, the equity risk premium has been negative. This is because stocks offer the potential for capital gains and have built-in inflation protection, but bonds do not. So this would kind of be an argument for stocks are cheap on a relative basis to bonds. And you can see that money has really started to come out of the bond space and into stocks. Now that's changed and bond yields are lower than equity yields. Makes sense to borrow cheaply if you're a corporation and invest that money. You haven't seen this type of premium here since 1980. As they say, when Kenny Rogers topped the charts and Star Wars first hit the theater, or Star Wars Empire Strike Back. By other measures, free cash flow yield versus corporate bond yields, stocks haven't been priced so attractively compared to bonds since the early 1960s. Now you can make arguments both ways. In fact, right now dividend yields, because of the price appreciation of late, I think dividend yields are at around 1.9%. That's still below treasuries. So the other side of the argument would be, well, stocks are not yielding as much as they should be. But we think those will continue to kind of be ratcheted up into the foreseeable future.